Trump saying in a social media post he has taken steps to ban large institutional investors from buying more single-family homes and will be calling on Congress to codify it. Joining me now on what this could mean for the housing market, we've got Lance Lambert, CEO and co-founder at ResiClub. Lance, it is great to see you. So let's start right there, Lance. President Trump says, you know what we should do? We should ban big institutional investors from buying single-family homes. What do you think, Lance? You saw the post. Smart policy?
Well, I think the big thing is we don't exactly know what's going to happen here. So we don't know if they're just going to ban new investment from scatter site home buying. We don't know if this is actually going to be implemented. Is Congress going to pass it? Will it be challenged in court? Is it going to include build to rent? Is it just scatter site? We still have a lot of questions. But what we do know is that whatever happens, if they are to pass some type of institutional home buying ban, it would impact, the impact would vary a lot by market. And the reason being is that the institutional levels of home buying are vary significantly across the country. So nationally, institutional investors that have 1,000 homes or more, they own around 0.5% of housing stock. If you take that threshold down to investors with at least 100 homes, then it's about 1%. But if you go across the country, there are many markets where it's closer to zero, but then you have places like Atlanta, where 4% of all single-family homes there are owned by institutional investors that own at least 1,000 homes. And within just single-family rentals in Atlanta, that figure jumps up to around 25%. So the impact will vary significantly across the country, whatever were to happen. If you did have a scenario where this is not just a ban on buying new acquisitions, but it's also a forced sell-off, then the impact would be greater because you would start to see some burst of new listings in some of these markets, in Atlanta, in a Charlotte, in an Austin, in a Tampa, in places like Jacksonville that have this higher concentration of institutional home ownership. As of right now, though, it's unclear if that's going to happen. If you read Trump's post really closely, he had said stopping them from buying more kind of insinuates additional purchases, not necessarily a forced sell-off. So there's still a lot of questions, but whatever does happen, it's going to vary a lot by market.
Lance, let me ask you, one question is placing your bet on whether you think, Lance, this actually goes from social media post to actual policy, Lance. I guess I'm trying to get at how seriously should we take this, in your opinion?
Yeah, when Trump announced his proposal for the 50-year mortgage, I polled 1,000 people within the next 24 hours, and it had a net favorability rating of 50 percentage points. So the vast majority of people were against the idea. And so as soon as Trump announced the 50-year mortgage, it was dead on arrival, right? Because that's how Trump does things. He likes to test them, see what the public thinks. And when you look at this proposal, I did the same poll, 1,000 people answered it, and it had a plus 50 percentage point net favorability rating. And it was really across political party. It's a very populist idea. A lot of people like it. So I don't know if it'll actually become law, but I don't think Trump's going to step away from this concept and the idea because it's going to get headlines and a lot of people like it.
Let me ask you this, Lance, and your timing is impeccable as always, my friend. We have a new post from the president. Right in your wheelhouse. I'll read it to you. I get your thoughts on this. He says, because I chose not to sell Fannie Mae and Freddie Mac in my first term, a truly great decision, and against the advice of the experts, it is now worth many times that amount, an absolute fortune, and has $200 billion in cash. Because of this, I'm instructing my representatives to buy $200 billion in mortgage bonds. He says this will drive mortgage rates down, monthly payments down, and make the cost of owning a home more affordable. It is one of my many steps in restoring affordability, something the Biden administration absolutely destroyed. I'm reading this, your reaction in real time, Lance. What do you make of that post?
Yeah, so the big thing to know is that in the bond market, yields and prices work inversely. So when there's more demand for the bonds, more demand for mortgage-backed securities, the yields and rates go down. So when the Federal Reserve during the pandemic boom period is buying a bunch of mortgage-backed securities, that's increasing the demand for those securities and driving down the yields, driving down mortgage rates additionally. And what we have seen is that last year, at the end of last year, Fannie Mae, Freddie Mac, the government-sponsored enterprises, started keeping more and buying some more mortgage-backed securities. Now, in the grand scheme of the mortgage-backed securities market, it was around 100 billion. That's not too big. But if you go to this year, according to Bloomberg, they expect that the Fannie Mae, Freddie Mac is going to buy around $200 billion in mortgage-backed securities. So it's a bit of additional demand for the mortgage-backed securities. It's probably putting maybe a teeny tiny bit of additional downward pressure on mortgage rates. You have seen mortgage rates come down over the past 12 months, around 75 basis points. The average now is around like 6.1, 6.2. It was around 6.8, 6.9 12 months ago. That's come down a bit. And a lot of that drive down in mortgage rates is not necessarily been because of the drop in other yields and treasuries. It's been because the spread between mortgage rates and the 10-year treasury yield has compressed. It's been compressing. That spread got really big when the Fed stopped buying mortgage rates back, or buying mortgage-backed securities back in spring 2022. And slowly that spread has been coming down. There's been compression there, and that's helped to bring mortgage rates down a bit. So it's possible that some of these measures by Trump could put a little bit of additional downward pressure on mortgage rates. But still, the big thing to watch here is the overall economy. If we were to see unemployment rate tick up more than expected, if we were to see a greater softening there, that's the scenario that would see us have a more material drop in mortgage rates than is currently expected.
Lance, we always benefit from your great insight. Thanks as always for joining us.
Thank you for having me.